Clean money, dirty secrets. How $2 trillion in criminal cash disappears every year. You're a drug trafficker in Mexico. You've just moved 500 kilograms of cocaine across the border into the United States. Street value, $15 million. Your operation worked perfectly. The drugs are distributed. The dealers pay you in cash. Now you have a problem. You're sitting on $15 million in small bills, tens, twenties, hundreds. The money is in duffel bags, in closets, under mattresses, in storage units. You can't deposit it in a bank. If you walk into a Wells Fargo with $15 million in cash, the bank will file a Suspicious Activity Report, SAR, with the government. Within hours, federal agents will be at your door. You can't buy a house with it. Real estate transactions require documentation. Cash purchases over $10,000 trigger reporting requirements. You can't even spend it freely. Buy a Ferrari in cash? Red flag. Pay for a yacht? Red flag. Live in a mansion while claiming to earn $30,000 a year? The IRS will notice. Your $15 million is worthless until you clean it. This is the fundamental problem of crime, making illegal money look legal. And there's an entire global industry worth trillions of dollars built around solving this problem. Tonight, we're investigating money laundering, how it works, who does it, why banks help criminals hide dirty money, and why, despite billions spent on enforcement, over $2 trillion in criminal proceeds get successfully laundered every year. This is Hours Deep. Get comfortable. We're going deep into the wash cycle. Money laundering is the process of making illegally obtained money appear legitimate. The term comes from the 1920s, when American gangsters bought laundromats and other cash-intensive businesses to mix illegal profits with legal revenue. The goal: hide the source of the money so it can be spent without attracting attention. Money laundering happens in 3 stages. This framework was developed by law enforcement and is taught to every financial investigator worldwide. Stage 1, placement. This is the riskiest stage. You have physical cash, from drugs, corruption, tax evasion, human trafficking, whatever, and you need to get it into the financial system. Common methods: smurfing, structuring, breaking large amounts into small deposits under the reporting threshold. In the U.S., banks must report cash transactions over $10,000, so you deposit $9,000 today, $9,000 tomorrow, across multiple banks using multiple people, called smurfs. Cash-intensive businesses: buying restaurants, car washes, nail salons, strip clubs, businesses that naturally handle a lot of cash. You mix dirty money with legitimate revenue. If your restaurant makes $10,000 a week legitimately, you claim it made $15,000 and pocket the extra $5,000 as clean profit. Bulk cash smuggling: physically moving cash across borders, hiding millions in shipping containers, trucks, or private planes. Once the cash is in a country with weaker anti-money laundering (AML) laws, it's easier to place. Casinos: walk into a casino with $50,000 cash, buy chips, gamble a little or not at all, cash out and get a casino check or wire transfer. Now your dirty cash is gambling winnings. Example: the car wash Breaking Bad got this right. Walter White buys a car wash to launder his meth money. Here's how it works. The car wash legitimately services 20 cars a day at $10 each, equals $200 per day. Walter claims it serviced 30 cars, equals $300 per day. The extra $100 per day never happened, but it's now recorded as legitimate income. Over a year, that's $36,500 in laundered money. He pays taxes on it, and now it's completely clean. The beauty, who's going to verify how many cars were actually washed? Stage 2, layering. Once the money is in the financial system, you need to obscure its origin through complex transactions. Common methods: shell companies. Create fake companies in multiple jurisdictions. Move money between them in a dizzying web of transactions. Company A in Panama pays Company B in the Cayman Islands for consulting services. Company B pays Company C in Delaware for management fees. By the time the money has moved through 10 companies across 5 countries, the trail is nearly impossible to follow. Offshore accounts. Move money to banks in countries with strict banking secrecy laws. Switzerland, Cayman Islands, Panama, British Virgin Islands. These jurisdictions don't cooperate easily with foreign law enforcement. Real estate flipping. Buy property with dirty money. Sell it. The proceeds are now investment income. Bonus: real estate can be held through anonymous LLCs, hiding the true owner. Trade-based laundering, over or under invoicing international trade. Example: you export $1 million worth of electronics, but invoice them at $2 million. The extra $1 million is laundered money disguised as business revenue. Cryptocurrencies. Buy Bitcoin or other crypto with cash. Move it through multiple wallets and exchanges, especially unregulated ones. Convert back to fiat currency in a different country. The blockchain records transactions, but if you use privacy coins, Monero, Zcash, or mixing services, the trail is obscured. Example: the shell game. A corrupt politician in Nigeria steals $10 million from public funds. He transfers it to a shell company in the British Virgin Islands. That company pays another shell company in Panama for fake consulting work. The Panama company buys real estate in London through a Delaware LLC. The property is later sold, and the proceeds go to a Swiss bank account. The politician now has $10 million in real estate investment profits. Good luck tracing that. Stage 3, integration. The final stage, bringing the now clean money back into the legitimate economy where it can be openly spent. Common methods: luxury purchases, buy expensive art, jewelry, yachts, cars. These can be resold and the proceeds are clean. Legitimate businesses. Invest laundered money in legal businesses. The returns are legitimate income. Real estate. Live in or rent out properties bought with layered money. Rental income is clean. Loans to yourself. Have your offshore shell company loan you money. You're just borrowing from your own company, which you secretly own. The loan isn't taxable income, and you never have to pay it back. Example: the Oligarchs yacht. A Russian oligarch with ties to organized crime wants to buy a $100 million yacht. He can't buy it with cash or his own name. Too obvious. Instead, a shell company in Cyprus, which he secretly owns, buys the yacht. The shell company gets a loan from a bank in Latvia. The loan is actually funded by the oligarch's own money, layered through multiple entities. The yacht is registered in the Cayman Islands. The oligarch rents the yacht from the Cyprus company. The yacht is his, but on paper, it's owned by an anonymous shell company, purchased with a legitimate loan. The methods and how it actually happens. Method 1. Real estate. The favorite. Real estate is the single most popular money laundering vehicle. Here's why. High value. You can move millions in a single transaction. Anonymous ownership. In many countries, including the U.S., You can buy property through an LLC without disclosing the true owner. Price subjectivity. Real estate prices are subjective. If you overpay for a property, who's to say it wasn't fair market value? Appreciation. Even if you overpay, the property might appreciate, giving you a legitimate return. Case study: Manhattan real estate. In 2015, the New York Times investigated luxury real estate in Manhattan. They found that nearly 50% of high-end properties, over $5 million, were purchased by shell companies, often from countries with high corruption: Russia, China, Nigeria, Venezuela. Example: one $15.65 million condo was purchased by a shell company tied to a Malaysian financier involved in the 1MDB scandal, a $4.5 billion embezzlement scheme. The condo was never lived in. It was just a safe place to park stolen money. Method 2. Casinos. The classic. Casinos are tailor-made for money laundering. How it works: 1. Walk in with $100,000 in cash. 2. Buy chips. 3. Gamble minimally. Lose $5,000 to $10,000 to make it look real. 4. Cash out the remaining chips. 5. The casino gives you a check or wire transfer. Now your $90,000 is gambling winnings, which are legitimate income. Why casinos allow this? Some casinos turn a blind eye because high rollers bring business. Others have weak anti-money laundering, AML, controls. Famous case: British Columbia casinos. In 2018, a government inquiry in Canada found that $1 billion in suspected laundered money had flowed through British Columbia casinos in just 2 years. Chinese nationals were bringing duffel bags of $20 bills, literally millions, into casinos. The casinos accepted the cash, no questions asked. Why? The casino made money either way. Method 3. Shell companies. The professional's choice. A shell company is a business that exists only on paper. It has no employees, no office, no operations. It's just a legal entity used to hold assets or move money. How to create one? Go to a jurisdiction with lax regulations: Delaware, British Virgin Islands, Panama. Pay a lawyer or formation service $500 to $2,000. Within days, you have a company. You can open bank accounts, buy property, or sign contracts in its name. The Panama Papers, 2016. The biggest data leak in history exposed how this works. A law firm in Panama, Mossack Fonseca, helped over 300,000 clients create shell companies. Clients included 12 current or former world leaders, including Putin, the Prime Minister of Iceland, the President of Ukraine. 128 politicians and public officials. Drug cartels, corrupt business people, tax evaders. The leak revealed shell companies used to hide billions in stolen public funds, avoid taxes, conceal ownership of assets, launder money from drug trafficking, arms dealing, and corruption. Mossack Fonseca claimed everything they did was legal, and technically much of it was. Creating shell companies isn't illegal, but using them to hide criminal proceeds is. Method 4. Trade-based laundering. This is one of the most sophisticated and hardest to detect methods. How it works? You control 2 companies in different countries. You trade goods between them, but you manipulate the invoices. Example: Company A in China exports $1 million worth of electronics to Company B in the U.S. The invoice says the goods are worth $2 million. Company B pays $2 million. The extra $1 million is laundered money disguised as payment for goods. Or reverse, the goods are worth $2 million, but the invoice says $1 million. Company B saves $1 million, which is actually laundered money staying in China. Why it works? International trade is complex. Customs agents can't verify the exact value of every shipment. Prices vary. Unless the discrepancy is huge, it goes unnoticed. Method 5. Cryptocurrency. The new frontier. Crypto has revolutionized money laundering. Here's why. Pseudonymous. Transactions are recorded on the blockchain, but tied to wallet addresses, not real names. Borderless. Move money globally in seconds without banks. Decentralized exchanges. Some crypto exchanges don't require identity verification. Know your customer/KYC laws. You can trade anonymously. Mixing services. Services like Tornado Cash or CoinJoin mix your crypto with others, obscuring the trail. How it's used? 1. Criminal sells drugs, gets paid in cash. 2. Uses a Bitcoin ATM, often no KYC required for small amounts, or peer-to-peer exchange to buy Bitcoin. 3. Moves Bitcoin through mixing services or privacy coins, Monero. 4. Converts to stablecoins or back to fiat currency via an offshore exchange. 5. Withdraws clean money. Challenges. Blockchain analysis firms, Chainalysis Elliptic, can trace transactions. Law enforcement has gotten better at following crypto trails, but privacy coins and mixers make it harder. Silk Road case. The FBI seized $1 billion in Bitcoin from Silk Road, a dark web drug marketplace. They traced the Bitcoin through the blockchain, but laundering small amounts through privacy coins? Much harder to catch. The enablers. Why banks help criminals. The banking industry's dirty secret. Banks are supposed to prevent money laundering. They're required by law to report suspicious transactions. SARS, Suspicious Activity Reports. Verify customer identities. KYC, Know Your Customer, monitor for unusual patterns. But in reality, many banks actively facilitate money laundering. Why? Because it's profitable. Case study. HSBC, 2012. HSBC is one of the world's largest banks. In 2012, they admitted to laundering $881 million from Mexican and Colombian drug cartels. Here's what they did. Accepted bulk cash shipments from Mexico in boxes designed to fit through teller windows. Ignored warnings that 60% of deposits from Mexico were drug money. Stripped information from wire transfers to hide that the money came from countries under U.S. sanctions, Iran, Sudan. The penalty, HSBC paid a $1.9 billion fine. No executives went to jail. Why? The bank was deemed too big to fail. Prosecuting it might destabilize the global financial system. HSBC made billions from the laundered money. A $1.9 billion fine was just a cost of doing business. Case study. Danske Bank, year 2018. Denmark's largest bank processed $230 billion in suspicious transactions through its Estonian branch between 2007 to 2015. Clients included Russian oligarchs, shell companies, and suspected criminals. The bank ignored red flags for years because the Estonian branch was extremely profitable. The penalty, the CEO resigned. No one went to jail. Estonia shut down the branch. Case study. Deutsche Bank. Ongoing. Deutsche Bank has been fined multiple times for money laundering. $630 million fine, 2017, for laundering $10 billion from Russia. The mirror trade scheme. Ties to Jeffrey Epstein despite his criminal history. Financing for Trump Organization projects with questionable funding sources. Again, no executives jailed. Why banks do it. Profit. Laundered money generates fees, transaction fees, account fees, loan interest. It's lucrative. Competitive pressure. If HSBC refuses dirty money but Citibank accepts it, Citibank wins the business. Weak enforcement. Fines are small compared to profits. No one goes to jail. Complexity. Global banks operate in dozens of countries. Tracking every transaction is impossible, or so they claim. The compliance theater. Banks employ thousands of compliance officers to detect money laundering. But in practice, compliance is often theater, checking boxes to avoid fines without actually stopping the flow of dirty money. Why? Because stopping money laundering would mean rejecting lucrative clients. Banks would rather pay occasional fines than lose billions in business. The chase. Why most laundering succeeds. The scale of the problem. The UN estimates that 2 to 5% of global GDP is laundered annually. That's $800 billion to $2 trillion per year. Of that, law enforcement catches less than 1%. Why is the success rate so high? Reason 1. Resource asymmetry. Criminals have unlimited money and can hire the best lawyers, accountants, and financial experts. Law enforcement is underfunded. Example: the IRS Criminal Investigation Division has about 3,000 agents to cover the entire United States. Compare that to the thousands of accountants and lawyers working for drug cartels, corrupt politicians, and oligarchs. Reason 2. Jurisdictional complexity. Money laundering is global. The money moves through multiple countries. Law enforcement is local. A detective in New York can't access banking records in Switzerland without going through bureaucratic international channels, which takes months or years. By the time they get the records, the money has moved again. Reason 3. Legal loopholes. Many money laundering techniques are technically legal or operate in gray areas. Creating shell companies? Legal. Buying real estate through an LLC? Legal. Paying inflated invoices for consulting services? Hard to prove it's fake. Prosecutors need to prove intent, which is difficult. Reason 4. Banking secrecy. Some countries, Switzerland, Cayman Islands, Panama, Singapore, have strict banking secrecy laws. They won't share information with foreign governments without a court order, which requires proving a crime has been committed, a catch-22. Reason 5. Corruption. In many countries, law enforcement and government officials are complicit. They're bribed to ignore money laundering or are laundering money themselves. Example: Equatorial Guinea. The president's son, Teodoro Nguema Obiang, spent $300 million on luxury goods, Ferraris, Bugattis, Gulfstream jets, a $30 million Malibu mansion, while earning an official salary of $60,000 per year. The money was looted from the country's oil wealth and laundered through shell companies. Did anyone stop him? No. He controlled the government. The success stories, rare. Occasionally, law enforcement wins. Operation Trojan Shield, 2021. The FBI created a fake encrypted phone network, ANOM, used by criminals. They intercepted messages about drug trafficking and money laundering. Hundreds arrested globally. 1MDB scandal, a $4.5 billion embezzlement from Malaysia's sovereign wealth fund. The money was laundered through shell companies and used to buy real estate, yachts, and even fund the Wolf of Wall Street movie. Some assets were recovered and several people were prosecuted. But these are exceptions. Most laundering goes undetected. The cost. Why you should care. Who pays for money laundering? You do? How? Higher costs. Money laundering inflates real estate prices. When oligarchs buy Manhattan condos as a place to park cash, it drives up housing costs for everyone. Weaker rule of law, laundered money funds corruption, undermining governments and legal systems, enables crime. Drug cartels, human traffickers, and terrorists can only operate at scale if they can launder their profits. Lower tax revenue. Money laundering involves tax evasion. Governments lose billions that could fund schools, hospitals, infrastructure. Economic distortion. Dirty money flows into unproductive assets, luxury real estate, art, yachts, instead of productive investments. The solution, or lack thereof. What can be done? Stronger enforcement. Jail bankers who enable laundering, make fines large enough to hurt. Beneficial ownership registries. Require disclosure of who actually owns shell companies. International cooperation. Make it easier for countries to share banking information. Regulate crypto. Require KYC for all exchanges. Ban mixing services. Limit cash. Some countries, Sweden, Denmark, are moving toward cashless societies. Harder to launder money without physical cash, but these measures face resistance from banks, who profit from dirty money, tax havens, whose economies depend on financial secrecy, privacy advocates, who oppose surveillance, criminals, obviously. Change is slow, so that's money laundering, $2 trillion per year in dirty money, cleaned and flowing into the global economy. Drug cartels buying car washes, corrupt politicians stashing cash in Swiss banks, oligarchs buying Picassos, shell companies within shell companies within shell companies, and banks, the institutions supposed to stop it, often helping, because at the end of the day, dirty money spends the same as clean money, and banks care about profit, not morality. Law enforcement tries. They catch a fraction. But the scale is overwhelming. The criminals are sophisticated, and the banks are complicit. The next time you see a luxury condo sitting empty, or a painting selling for $100 million, or a shell company buying farmland, ask yourself, where did that money really come from? Chances are you don't want to know. This has been hours deep. Thanks for laundering through this one with me. If you want us to investigate other financial crimes, tax evasion, insider trading, Ponzi schemes, let me know. We've got more dirty secrets to uncover. Stay clean, or at least stay informed.